Hello, I'm Stephen Mayne, contributor and intelligent investor, founder of Crikey and shareholder activist.
And I'm Evan Lucas, economic futurist and a host of the podcast Exchanges with Evan Lucas. And we are...
The Money Café. And Evan, Alvin's got the week off. We'll be back next week. So we're holding fort electronically in the cafe today. And we have to start with Mark Carney and Trump in the Oval Office. Did you watch it? Did you see the clips?
Did I watch
not as
it?
big as Zelensky, but great effort by Carney, I thought, just holding the line and staring him down.
Yeah. Oh, did I watch it? He has been in my view, the most exciting thing to happen in global politics because, again, being the economist that I am and watching geopolitics, for Canada to have someone of his quality, and that's the right word, in power right now with the situation that they have, because they are spaghetti linked with the US. That's the only way I can describe it. It is untangleable. No, that's not a word, but I'll leave it at that. For what he said, how he did it, his intellect, skill, and nous is something that 10 Trumps couldn't even get close to scratching the surface on Mark Carney. This is a guy who steered the UK through Brexit when he was head of the Bank of England, steered Canada through some tricky periods in the 2010s when he was head of Bank of Canada, shows technocrats can do it. And the way that not only did he stand up, but you could tell that subliminally the messaging was very clear. A, we're not for sale, and no matter what you say, we ever will be. And that actually Canada can go it alone. We don't need the US.
And by the way, we're your biggest customer too. So
correct. But not only that, there was also
mistreat us.
Correct. I think what he was also very clear in pointing out, like we've seen this, and we're going to get into this, I know, with AGM and earnings season, but I just want to talk about Ford, which I think it's not the canary, but it's the gorilla in the coal mine. The fact that Ford has now ditched forward guidance for the first time in basically living memory, has told the world that they're going to get about a $2.5 billion hit from the tariffs, and that the US forgets that they don't have any aluminium mining or any aluminium deposits. All of it's imported. They've added a 25% hit on their own car making industry. And
that's why that's why the US markets, I mean, that was ridiculous, the 9 days in a row increases. We've now had 2 days in a row of falls, 1% overnight. That's the reality of the earnings hits from tariffs means that the earnings forecasts are not going up. They're probably going down. Ford has belled the cat. And if Trump goes ahead with his tariffs, and he can't do 90 deals in 90 days and all that stuff. So US economy's heading for a recession. Earnings are heading off a cliff. The ports are very, very quiet. And until they sort things out with China and the world, the US is an absolute car crash.
Yeah, and the final part of the Canada story is that who's the largest supplier of aluminium to the US? Canada.
They could do a lot of damage. Potash, all the fertilizer. Yep. They can turn the lights off in New York. I mean, look, the leverage that Canada's got. If they chose to play it.
And they won't.
Captain Cool Carney sitting there just looking, the Iceman, absolute Iceman, sitting there really calm next to him, just, I agree, leader of the free world. Yeah. And the best man to play the cards with Trump.
So on that, I mean, the lead on is our election that we've just had. So we are doing this the Wednesday after the election, looking at someone like Mark Carney and the kind of strength / almost awe that I have for him being there. What's your takeout from what you saw on the weekend?
Oh, look, Australia is the world's most stable democracy. I mean, look at Germany. They are trying to put together a coalition of the equivalent of Labor and Liberal, to head off the far right. So what they're trying to do is you've got Labor and Liberal trying to put a coalition together to stop one nation, the right-wing, hard right insurgency. And it's messy. It's difficult. The previous coalition fell apart. So stable democracy, firm majority government for Albanese. I think there's a little bit of Jim Chalmers has a little bit of Carney-like coolness and calmness. I think that the Chalmers, he performed very well on the Money Café during the election. And Albanese's the front man, more lefty, non-markets guy. But I think overall, Liberals weren't ready, didn't deserve it. And the markets
they were
very
more than
comfortable.
Not ready.
Yeah, I mean, it was just a fiasco. We had Talking Finance this week. We had Mark Carney and Saul Estlake on it for subscribers to The Intelligent Investor. And, Saul Estlake was just scathing, just the Liberal economic team, Angus Taylor and Jane Hume, the weakest team he could remember in all the elections that he'd watched. So I think most people are saying the Libs deserve to get a flogging. Greens have also lost potentially all of their lower house seats, and Labor's just come through with a comfortable 10-seat plus majority. I mean, it's just extraordinary.
Yeah, and I think that is the final part that I want to say. The only wrap-up I have from the weekend is there's been this growing suggestion, I'm glad to use Germany as the example there, that Australia, with the world of social media and echo chambers and blah, 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 the rise of the teals, etc., that pluralism was going to basically be the future of Australian politics, and that, gaining, not just a majority, but an absolute sizable majority like the Labor Party has got was a thing of the past. And we've seen that that's very much not the case. In fact, as you said, the Greens and all major minor parties, bearing, unfortunately, I'm okay with saying that, One Nation, who did get a slight bump, it shows very clearly that if push comes to shove and Australians want certainty, they'll do that. And I agree with you what you said around having that stable democracy that we had. The Saturday takeout, whether you like the result or not, doesn't matter. We have an incredible, stable, very civil democratic system.
That's right. Compulsory preferential voting forces everyone to the centre, and very few other countries in the world could point to the stability of our democracy. So, I mean, even the Aussie dollar's gone through 65 cents early this week. So, as the US, that's more about a story of the US dollar.
And the proxy China story as well.
Yeah, that's right. But there's no sort of election fallout with markets. Investors are nervous. There's none of that stuff. It's just basically business as usual. Looking forward to how Albo performs when he gets to sit with Trump in the Oval Office. It's almost becoming a rite of passage for national leaders now to try your luck in the Oval Office.
So when do you think he's going to get the call? When do you think he's going to go?
It'll be the next 3 months. I think it has to happen. I mean, they've been on the phone, obviously, but yeah. So I think we're all looking forward to seeing how that goes. But Albo did well on this election. There's been no fallout with China. I mean, they've come out and said they're going to compulsorily buy back the Port of Darwin. That is a controversial thing for a national government to say after they bought it for, $500 million a few years ago. But there wasn't a blow-up with China. There wasn't a blow-up with Trump. So they've got through the election with no sort of – often elections cause conflicts. People say things, there are events, but we've actually got through it without too much baggage. You can argue they've got structural deficits for as far as the eye can see because they've made too many big spending promises. But look, the markets are comfortable with $1 trillion of federal debt at the end of the day. So on we go with what next? Probably bank earnings season, Evan. This is where the markets have been focusing this week. You've had some thoughts on that?
Yeah. So I think the main thing to take out is banks, and I know you're going to talk about this in a minute, but the banks are priced to perfection. I mean, if you look at Westpac was up something like 20% in the last 4 or 5 months. Why? On what? Exactly. Give me a reason, Stephen, why you'd be piling into banks. NAB, not as much, but overall is actually a stronger bank. The results so far, and we're recording this on Wednesday, the 7th of May, so ANZ is out tomorrow, which is when you'll get this and hear this. But overall, the banks are telling you what they've been telling us publicly, which is they're doing okay. If you're NAB, they've still got structural issues, in my view. If you're Westpac, they're still seeing lending. They're still doing reasonable numbers. If you're Westpac shareholder, unfortunately, you've got a slightly weaker than expected dividend. Net interest margins are the key takeout, I think, Stephen, which is that competition is driving down margins, which I'm okay with because it makes them more efficient. It also means that you and I, the consumer, get a better deal, apparently. Overall, though, Australians' love affair with lending is not going away anytime soon. And I think that's the key takeout, is that if you look at new growth, if you look at home sales, it's still the absolute bread and butter of the two that have reported. It'll be the bread and butter of ANZ when they report tomorrow. So should we talk about CBA and the massive gorilla in the room that is CBA?
I mean, I actually went to a virtual AGM this morning, Pepper Money, okay? And they've got $19 billion under management, consumer loans, car loans. KKR floated them. I think it was at $2.60 a share in 2021, and now they're down to $1.60. So, like, the investors are down $200 million. Their market cap is $750 million. But I did say to them, why are you performing so badly? Why are your shares so bad? And the big banks just dominate. I mean, the Commonwealth Bank is today worth $279 billion. It's almost more than the other big three combined. Westpac 109, NAB 108, ANZ 88.7. That comes to 305 billion. So it's not the big four anymore. It's the big one and then the next three. And it's just unbelievable that our big four banks are together or the big five if you add Macquarie with their $74.6 billion. They're worth $659 billion. We're meant to be a mining country, and I'm just getting bored with so much of our stock market value being banks, and they get through the election without any grief as well, you know.
Oh, I'll give that time. I think that what I want to point out there is the difference also that NAB sort of moves into it, which is NAB has clearly become, inverted commas, the second player in that space. It has got its books in order a little bit better and it's moving on the new way. Obviously, you do have a new CEO in Andrew Irvine coming out from Ross McEwen, but they are a little bit cleaner than the other two. I agree with exactly what you're saying, though. But again, we have gone from being the country of digging holes in the ground to the country that loves lending. I mean, that is the difference. I mean, the way I'd argue it and the way that I spoke about it with the CEO of Police Banking, Greg McKenna, in an exchanges that I just did, which is that when did the home go from being part of Maslow's hierarchy of needs to being a house that you invest in? Because your overall wealth now is so heavily paper traded with the value of the home that you live in and the houses that you might then put onto. And so it's easy to argue why the banks are so attractive. The second part, and I want to get your thoughts on this as well, is the rise of passive investing also is slightly distorting things here, in my view, because you have the largest player on the ASX, which is CBA, gets, roughly 10.1% of all passive investments into the ETFs, whether it's the ASX 200 or 300 or whatever it is they're doing, that constantly actually adds market cap support to a bank that clearly is very, very good. And I want to point that out there. It's very, very good. And it's the reason.
But it's not that good. It's not $279 billion.
It's not that good.
So you're right. Index investing is overhyping it. And I've been going to a lot of smaller AGMs and EGMs this year. So if a company has an EGM, I buy a few shares and go along. What has struck me is how many absolute dogs with huge losses there are sort of outside the 200. And I'll just give you my roll call tomorrow for AGMs that I'll be attending tomorrow. So ARN Media is at 9 o'clock. They have accumulated losses of $1.225 billion. Now, I know you never hear Kyle and Jackie O talking about that, but they are an absolute dog. Capral Aluminium at 10 o'clock. They've got accumulated
losses. You might when they
losses.
find out their shareholding part of their contract they signed for.
Yeah, that's been a dog for them as well. But Capral Aluminium has accumulated losses of $331 million. Overall losses for shareholders when you put in the market cap is about $225 million. Then you've got Hutchison Telecom. They've got accumulated losses of $4.25 billion. Basically, they ploughed on when OneCell went broke, and it's been a massive loss maker, although they've now merged with TPG, and there's a bit of value there. I have to give TPG a mention. Right now, as we record, they're having a physical AGM in Sydney. I mean, what a bunch of dinosaurs. An internet company with 23,000 shareholders that makes you turn up in person. So if you're a customer of AAT
so it's closed.
or Vodafone, I can't do it.
Right,
so I can't go.
You can't do both.
Because Rob Milner, who's on the board, a cranky billionaire Soul Pats guy, he always tries to do physical AGMs because he hates the scrutiny. But when he gets his mates from Vodafone and TPG and IONET and all those brands they put together to agree to physical only AGMs, it reduces scrutiny. So anyway, that's another issue. And tomorrow you've also got an AGM, a company called Arovella Therapeutics. They've got 90 million accumulated losses. Woodside over in Perth at 10 o'clock. The stock's gone from $40 to $20. So Woodside, the oil price, the gas price. Mm-hmm. So it has, gold might be booming, but gee, the oil and gas companies are doing poorly at the moment. And
not surprising, 4.5-year low in oil. I mean, we're at $60 a barrel. I mean, that's...
So this, the Greens narrative of, big gas companies making out like bandits. I mean, CBA is now worth 7.4 times Woodside. And then finally, you got the hybrid AGM up in Port Moresby of Bougainville Copper, the old copper mine in Panguna, which got shut in 1989 and is now still sort of controlled by, or the company controlled by Rio Tinto, but they're having a hybrid AGM. So I'll be able to lodge questions from Melbourne into Port Moresby, but you can't do it to TPG or even GPT last week, the big property company. So
I just want to ask you a question then. So just sorry to interrupt. On Woodside and what Meg O'Neill has done and the future of gas in this country, what would you like to see Woodside do? I mean, they sort of damned if they do, damned if they don't. They've gone through a pretty structurally tricky period, and I would argue a structurally declining period. that is there now for all to see. It's why Shell, etc., and there's now discussions that Shell and BP are going to merge to become the largest oil producing company on the planet. Where is the future of Woodside?
Well, I mean, you do have options. You can pivot to renewables, but they're not doing that under Mega.
They're not going to do that.
Exxon, they're all in. They're all in gas, fossil fuel. So they're still working hard for their approvals to expand the Northwest Shelf. They've just announced a massive $20 billion plus expansion project in, I think it was Louisiana or in the US.
Mm-hmm. Yep.
So look, Woodside is all in on fossil fuels. They're the only Australian major because obviously BHP got out and offloaded all their oil and gas assets to Woodside as part of when they collapsed their dual-listed company and came back to being wholly focused on their ASX listing. And you go to a BHP AGM and they say, quote, "The faster the world decarbonises, the better it is for BHP." So they're going long on copper and potash and things like that, the sort of the future metals, which you're investing in for a clean, green, net zero type scenario. Whereas Woodside is obviously just not doing any of that, and they're just all in fossil fuels. Interesting that even the seat of Fremantle over in WA may fall to an anti-Woodside, anti-Northwest Shelf sort of climate 200-backed independent taking a seat off Labor. So even out west, there is political consternation about Woodside being the only Australian-based all-in fossil fuels, oil and gas major, and it has not been a good experience for shareholders. But you never know, the oil and gas price might pick up and the stock goes back above 30. But Woodside under $20 a share, didn't think I would see that.
It's fair enough. I'm just going to, before we finish up and get to questions very quickly, I get this question almost every day at the moment, Stephen. I don't know about you, but where is the RBA going? Because I think we need to bring this back domestically, and we are, as we speak, 13 days away from the RBA meeting for their May meeting. They will cut. I think what I just want to preface to finish this off is that don't expect shock and awe. Don't expect a New Zealand-style scenario or even what happened in the UK with the RBA. We went up very slow and will go down very slowly. So expect them to work in quarter notches. So quarter of 1% they may hold off in July because they won't have all of the data for the second quarter, and then that will allow them to go August, September, November. That's what the market forecasting is there. And I also then, just very quickly back to stocks, was today there was a quarterly update from JB Hi-Fi. I found it fascinating that there was a
6% sales uplift. Booming.
Yeah, but the Kiwi one, if you didn't see that, 19% number growth in their Kiwi stores. New Zealand has seen near enough to 1.25% out of their cash rate. Do you think they wanted to spend? That is also the way I'd answer this, is that the RBA is very aware that if they go too hard on the downside, like on going outside, that they'll lose track of the good inflation story that we have. So yes, they'll start cutting, but it will be very conservative. There'll be people who will jump and scream and say that they're not doing a good enough job. Argument to the counter is slow and steady wins the race for a good reason.
It's funny, I just looked up the JB Hi-Fi share price at 11 a.m. on Wednesday. Down 5%.
Price to perfection, right?
Down $5.45 to $98.50. I mean, the damn thing was floated at $1. Macquarie,
it was the most shorted stock at $20. Remember that?
It was floated at $1. Woolworths was going to buy it at 16 or 18 or something. It was through $100.
Yeah,
it was through $100. And how many $100 stocks do we have? You got Macquarie, CSL, CBA. There's not many $100 stocks. Making a ton it's easier being a test cricketer making a ton than an ASX listed stock.
The acquisition of also Good Guys, geez, that strategically has worked out incredibly well. There was always this argument, it's overs, Good Guys is a bit of a flat company, blah, blah, blah. The integration of the JB Hi-Fi mantra and culture has turned Good Guys into this other additional cash cow to their feather.
It's funny how you pick up things. I remember going to a JB Hi-Fi AGM. They used to have it at the Computershare Conference Centre in Abbotsford, and they'd give you a couple of dry biscuits and you get 12 shareholders there. And I would always get stuck to them and say, why don't you give us a voucher for turning up? You're so cost conscious, you're just making this AGM a nothing event.
That's what they're good at.
They're good at that. And they said at the AGM,
that's what we do.
My favourite stat is that only 2%, our rent cost to sales ratio is only 2%. We value being off the main strip. Now, they've obviously gone into most of the Westfields these days, so that number has risen. But the original grungy, offbeat, low rent culture. And another time I asked them at their AGM about how many unions have you got? You're paying award wage, and they just said no union members here. So they're just, they run a tough industrial relations game.
But their staff love them.
Down,
this is the other thing. Their staff love them.
Oh, they do. It's a fun place to work. Fun place.
So, I mean, that if you want to develop a culture of, that kind of level, you don't need the old school idea. They have shown that they can deal with new world culture, with particularly Gen Zer culture. They are the best at it. No, that's all I'm going to stay with them.
That's right. And they've ridden the gadgets boom.
Yep.
The electronics boom absolutely magnificently. So
we got to get on. Let's do it.
Now, before we get to this week's questions, here's a quick word from our sponsor.
Want to hear how a pro spots opportunities others miss? Nathan Bell, Portfolio Manager of the Intelligent Investor Australian Equity Growth Fund, is hosting a live webinar to show you exactly that. His team's approach to finding undervalued stocks and why the fund is expected to outperform the ASX 200 in the years ahead. He'll also share insights into the fund's investment strategy and answer your questions live. Register now to join the session on Thursday, May 15 at 1 p.m. or sign up to get the recording. Visit offer.intelligentinvestor.com.au/IIGF.
Now, Evan, first up, just going to follow up on a couple of things from last week's cafe. Just to sort the record out on the First Home Super Saver scheme. India, we had a question from India concerned about whether she'd be still exposed to shares within the sort of the super environment. And there's two things to say about that. We had a number of people who wrote in. Firstly, when you're choosing your allocations within super, you don't have to be exposed to shares. You can choose an all cash allocation. So you can choose conservative allocations, but also, just as importantly, within the First Home Super Saver scheme, the earnings are the deemed interest rate, set by the ATO. So as you divert your super into this designated First Home Super Saver scheme, your earnings will be the deemed interest rate, which is generally set at the 90-day bank bill plus 3%. So if you look at the ATO website at the moment, for the current quarter, the deemed interest rate is the 7.17%. So you're not taking sort of earnings risk as you go into that structure to build savings. And we had one listener, Josh, who wrote in saying he's a very happy user of the First Home Super Saver scheme. And the best thing that he and his partner found about it was forced savings. Unlike a bank account, you can't take your money out, you're forced savings. And then he's saying we're very happy users of the scheme. So, apparently it's very popular. Lots of people have been channeling their super earnings into that scheme, and it's not risky because you get the deemed interest rate, which may well change if we get the rate cut coming up because it's the 3% above the official rate, basically. But just tidying up that, and our first question is actually, I think I'm going to go to the question on the build to rent scheme from Will, who says that should Australian super funds receive additional incentives such as further tax concessions for build to rent developments over and above other market participants? And Will is saying that the build to rent scheme has been an overwhelming success. Many super funds are getting into it. They're operating the facilities. And basically, should the government provide even more incentives to get more super funds investing in build to rent schemes, because you do have the benefit of a long-term stable landlord/tenant. And Will's basically saying, should the government top up the returns to further incent allocations from super funds into build to rent developments to solve the housing crisis? What do you reckon?
It's a very good first step. The next step is not just build to rent, it's build to rent to buy, right? So what you're also seeing with the super funds, but you're also, again, getting back to banks and what we've been speaking about before, the banks are already talking about doing a system around this, which is that your rental income actually goes to paying off the cost of the property. This is the next step, and this is where the banks will feel into it. So absolutely, incentivized superannuation funds, talk about that very clearly. The build to rent scheme is starting to work. Again, the caveat is that we still don't have enough construction workers in the country to do it. Construction costs are still quite expensive because of the supply constraints around particularly labour. So that's a caveat and one that needs to be addressed. But if we are to address the supply side issue, which is realistically the biggest issue in the housing market, then this is certainly and has been shown to work. But yeah, the banks are now going a one step further, trying to jump above the super funds and offering basically build to rent to buy. And that is that your rental income actually starts slowly but surely buying your house off. That will be the additional step. But overall, I agree with Will's sentiment. I agree with the program. It is working. The catch is that it's slow is the other part of it. It's a very slow
does
system.
Need to be turbocharged, doesn't it?
Yeah.
So now, Nicole, female listener here, I have a comment and a question. The comment, I really enjoyed the Jim Chalmers episode a few weeks ago. As an economist, I usually err towards voting Liberal, but neither had convinced me. I'm one of those Bonner Queensland voters who went Labor for the first time. It was mostly from the interview with Chalmers. My priority is economic management over the front man, and Chalmers' confidence, knowledge, and candour on the Money Café convinced me. Now, Nicole's question is, I would like to do a PhD sometime in the future. There must be topics worth answering in finance, economics, and society. Do you have any thoughts on research questions, new concepts, or failures that academics could be exploring? And interests have included business innovation, technology, social behaviour. So I've got a couple of thoughts on suggested interesting PhD topics. I know that Paddy Manning is doing the history of News Corp as a PhD at the moment. Have you got any thoughts on a sort of topic in the economic space that you'd like to see PhDs done on?
Yeah, so I've actually been in discussion with RMIT about that exact question in terms of doing it. And the one that they are super interested in is health economics and the rise of the digitization of health and the fact that it could actually be making us pseudo-sick faster. So if you think about your wearables that are now basically a staple of Apple's earnings, a staple of players like Google as well, is the amount of health data and health education that we're getting actually leading to a negative return. That's one that RMIT is looking at very closely.
I actually heard Glenn Davis give a speech a couple of years ago, the former head of Prime Minister and Cabinet, and he said Australia has a shortage of health economists.
Yep.
We need more health economists. So that's actually a good point. A couple I'd like to see. How public company board elections work in Australia, and should we switch from 3-year election cycles for directors to annual elections for directors like in the US and the UK? I reckon some academic study on the impact of that would be good. Maybe one other one is how climate activists got Australian public companies to some of the best climate disclosure in the world through submitting dozens and dozens of shareholder resolutions over the past 15 years. And I've seen them. They just keep hammering the big banks, the big insurers, Santos, Rio, BHP, with these shareholder resolutions calling for more disclosure. And we have landed with probably arguably the best disclosure in the world in terms of our major listed companies and their carbon plans, their pathways to net zero, scope 3, all that stuff. And a lot of it has come from this sort of democratic shareholder activism point of view, just putting up shareholder resolutions for the vote. So someone to have a good look at that impact, I reckon, would be a worthwhile PhD.
So that brings to the next question, which is Peter, and I think this is a perfect question right now because I know this is something that's quite big on your sort of radar, Stephen, which is if boosting productivity is the goal or number one goal of the new treasurer, is there merit in major gambling reform as quick win productivity measure? Highly addictive, seems to be a drag on the economy. It leads to domestic violence, crime, poverty, misapplication of productive capital, etc. Could empowering the government resist state capture of major sporting and gambling lawlessness and allow the Australian people to evidence-informed reviews? This, I know, is something right up your world.
Yeah, well, look, I mean, with $31 billion a year of losses in the world's biggest gamblers, I've long been involved in that campaign with Tim Costello and others. I don't know that it particularly ties in with the productivity debate. It's more a sort of a wealth destruction debate, and then you get greater impacts on families and social services and prison populations, et cetera, et cetera. I was disappointed that Albo had his election party on Saturday night at a big pokies club in Sydney, the Canterbury Hurlstone Park RSL, which takes more than $40 million a year from gamblers. He was there back in 3 years ago. Mark Latham was at the big Mounties Club, enormous pokies venue in Sydney when he lost in 2004. So sadly, Sydney is the most pokies captured city in the world. The Labor Party even runs their own pokies venue in Sydney and Randwick, another 4 in Canberra. So, and just said to me, everything it said about Australia's addiction to gambling is the Prime Minister turning up at a big pokies venue to celebrate his win. It just, it just says it all about our addiction, and we should do something about it. Now, Craig says, thanks for the excellent podcast. I usually listen to it during my long drives on the weekend. I'd like to think of myself as apolitical, but wanted to raise a couple of policy ideas proposed by Gerard Rennick's People First Party in the last election. Now, Gerard Rennick's a former LNP senator who's run independent in Queensland when he lost pre-selection, and he may actually win in Queensland. He's up against One Nation and the cannabis, legalised cannabis party for the last spot. We won't know for weeks, but he suggested a national infrastructure bank and a government insurance office. And the government insurance office is more just about insuring uninsurable flood risk areas and bushfire prone areas. Look, I think there have been schemes like that, Craig. Governments are becoming more interventionist over time. So a national infrastructure bank, a government insurance office, I don't know. What do you reckon, Evan?
I think, again, the intervention is there. Having state-owned enterprises in this space just puts risk elsewhere, right? So if you're trying to de-risk certainly some parts, you'll put the risk elsewhere. And so, again, my concern is that you put lending risk into the government rather than into the home, or you put lending risk into the private market. I get why it sounds great, but there is also a reason it doesn't normally pay off to do it, because it just puts risk. It will pop up somewhere, and it normally pops up in areas you'd least expect. So all good intentioned, it will lead to problems in my view.
Yeah. Now, question 6 from Travis. Back on the rental property market, listening to a recent podcast on long-term leases, I wanted to share my experience. I own a rental property and very lucky to have a great tenant. But a few years ago, I negotiated a 2-year lease. I wanted to build in a fair increase after the first year. I was told that the rate can't change for the agreement period. I lost money in this arrangement as the rent increased over $100 a week over the 2 years. I've now gone back to 1-year terms. The rules need to change in order to allow for longer leases, which are fair to all parties. Now, I agree with Alan Kohler last week on the Money Café, saying it's a total schmozzle not having a national rental scheme, with every state and territory being different. And the fact that under the Travis scenario, I'm not sure what state he is in, that you have to have fixed leases, you can't actually have an escalator built in. That just forces everyone into insecure 1-year leases, doesn't it?
It does, and not only that, it then leads to the month-on-month once the contract runs out, right? So it leaves the renter unsecured, it leaves the landlord unsecured, it exposes both sides also to the price fluctuations of monetary policy and changes to regulatory policy. I think when you look at what goes on at the granular level, which is what Travis's concept is, if the deal actually benefits both, why would you not let that happen? And that's, I think, what's also, again, back to the previous question with what Craig was asking, same concept, which is this is, again, where regulation acting as the guardrails is great until the guardrails turn into concrete blocks and you smack it into them. And I think that's the only sort of, analogy I can use, is that the intervention, once again, has gone too far. The rubber band will and should hopefully snap back, but don't hold your breath. It'll happen anytime quickly. But again, it all fills into the same problem, is that the allowance of the individual contract or group to do what's needed that actually works for all is lost in the regulation and lost in the rules.
Yeah. Now, AJ also wrote in responding to Charlotte's question on rental reforms, where there was a discussion about how Germany has a great system with longer-term leases. But AJ points out that in Germany, it's much tougher to break the lease. You've got to give like 3 months' notice. And in Germany, tenants are far more responsible for things like curtains and floor coverings and fittings. So it is, it might sound great having, overall longer-term leases, but in Germany, the fittings question apparently is quite a burden on tenants. And if you're in a long-term lease, it's quite tough to get out of them in Germany. So anyway, over to you, Evan, your turn. Which question do you want?
Well, look, let's do Mason. It seems that productivity growth in the market sector, while flat, is the much better position for the non-market sector. As an Australian find themselves working in non-market sectors, particularly in areas like healthcare and education, this decline in productivity growth is becoming proportionately more of a drag on the economy. How do we get productivity up in the non-market sector? Is this a non-market sector-wide issue, or is there other subsets of the sector driving it down? It's a little bit longer than that. But this question is huge, because this is going to be the discussion going forward over the next 6 years, particularly, which is that we've seen from the weekend the Treasurer say, I want to concentrate on productivity. The first thing I want to point out is that the other issue at the moment with productivity is a technical one. And the technicality is measuring productivity in services and service-based economies is very tricky. And the current models would argue, even themselves, that it's not perfect. So although productivity in the current modeling suggests that it's going backwards, it may not actually be as clear cut as that. Now, I'm going to leave it there. I'm going to let you go first because there's a couple of things other things to couple onto that.
I think Mason's also alluding to the fact that if you add in the state and federal governments together, we currently have a structural annual deficit sort of heading up towards $100 billion a year. So basically the governments are being unproductive in that they're spending $100 billion between them more than they're raising. And to sort that out, you probably would need a productivity piece in much of that government spending. And look, we had Saul Eslake on Talking Finance this week, and he said the things that he cited, apart from saying that Labor has made so few promises that would be productivity enhancing, they're actually quite boxed in terms of what they can do. But he talked about better use of data, eliminating non-competes, which they're doing, some more changes on competition policy. And look, the elephant in the room when everyone talks about productivity is AI. And AI is going to smash through a lot of services jobs. Customer service, AI.
It's just going to speed them up. I think we need to point out very clearly on that is that AI has been around for 35, 40 years, right? In terms of what artificial intelligence is. I mean, the ability to regulate your house temperature, that's technically AI. The way your phone works. What we now have is generative AI. And I think what's also slightly lost on generative AI, there's this belief that it thinks, it collates very, very quickly and gives you an answer of that collation. Doesn't technically think. So what it does is it makes you more efficient because it can collate the information you need to then think and make a correct or more informed decision than if you were going to do it yourself. So I agree with that. That's where AI productivity, I think, is lost in this idea because people see AI as a negative thing. It's a very positive thing, like moving the horse and cart into the car. You are speeding up thinking and processing for human decision making.
Now, we had one more little follow-up from last week from Mitch, who's a financial advisor, who wanted to clarify the situation with wrap superannuation platforms. And he wrote in and said that you don't need an SMSF to access a superannuation wrap platform. And these accounts are available to any superannuation member, though they're typically accessed through a financial advisor, such as Mitch. And Mitch says one of their main advantages is the level of control they offer. You've got greater control over the underlying investments using the wrap platforms. And Mitch even claims that the fees can be lower than your standard industry fund, although obviously that's potentially a contested claim. And we've also had another interesting question from Brad. It was he's following up on something I'd said about how hard it is to sell off land if you're a council because the local residents and everyone complains about it. And then Brad's basically saying there's far too much land allocated to public golf courses and we should be selling off public golf courses. And Brad says there's 4 of them within 5 kilometres in Sydney and that would solve a lot of housing problems. So there probably has been a gross misallocation of city land to not particularly well utilised golf courses, both private and public, but just politically you try and shut a public golf course and you just get smashed. It's just too hard politically. You would need to have some big government coming in and telling you to do it because no group of councillors are ever going to say, hey, let's just turn our public golf course into resi development. It's just the practical realities of the politics of planning and development is that public open space, any loss of public open space, including a golf course, private or public, is just politically incredibly difficult to take away from the community. We've probably got time for one more question, I think, Evan, and let's go with
I'll let you choose this one.
Yeah, okay. Marianne, on the question 8 on the granny flat. So Marianne says that it was interesting in the discussion on the granny flat, but we neglected to mention the risks around capital gains tax, and this applies to homeowners looking for a solution to living arrangements for their aged parents. And she linked to it a very interesting article about granny flats saying that to get the benefit, to not be exposed to capital gains tax, you do actually need things like the beneficiary of the granny flat to be over 67. You need to have a written agreement with, your grandparent or your parent that they can stay in there for the rest of their life. So otherwise, if you just whack in a little granny flat, and just rent it out and call it a granny flat, you will cop capital gains tax. That is an income generating asset at your prime property.
Yep.
So beware the pitfalls. You can't just do a fake granny flat as a side little
side hustle.
Side hustling. You've got to actually, ideally, the rules are the over 67, a written agreement, and it needs to go for the balance of that person's life. So that's quite interesting because a lot of states are really turbocharging the old granny flat thing and saying that it's an as of right planning situation where you can bung it up, but watch out for the tax man coming in if you try and do it as a side hustle without a genuine, normally older person benefiting from a long-term subsidised occupancy agreement.
Yeah, and it goes hand in hand with what we're seeing from the ATO in general, which is that they are this year going to start cracking down on second income streams. So it's not just the capital gains tax you're getting on that granny flat. It's if you're doing things like Airbnb, or if you're doing Uber driving, or if you're offering consultancy services on the side. That is their new focus, to start having a look at the fact that people are going, I have my normal job with my pay as my go scenario, but I also have a side hustle that might be a company, that might be other sole trader income streams that's not as heavily reported. The ATO has made it very clear that they are going to start looking at you very closely.
And with deficits forecast for as long as we can see, and $1 trillion of debt coming, I can just imagine Treasurer Chalmers signing off on a big ATO push to bring in even more money from ordinary taxpayers who are already paying over $300 billion in income tax. So, yes,
62% of total government revenue is personal income tax, according to the government.
It's the golden goose. It's very high relative to the rest of the world, and they're highly dependent on it. And with these crackdowns on little side hustles, that is just even more personal income tax coming in. So watch out. So on that gloomy note, Evan, the tax man's coming for you. We better wrap it up. Now, thanks for listening to today's episode of the Money Cafe. The great Grandpa Alan Kohler will be back next week with James Thompson. So send in a question and they will answer it together by emailing themoneycafe@eurekareport.com.au. Until then, I'm Stephen Mayne, one of Intelligent Investors contributors, founder of Crikey and shareholder activist.
And I'm Evan Lucas, economic futurist and host of the podcast Exchanges with Evan Lucas.
And we'll see you soon. Thanks for listening.